Today, I'm going to teach you guys how I made $2,500 in 6 days with an option strategy called the poor man's covered call. And I'm going to show you my step-by-step process and my thought process behind doing all of this stuff. And this trade on this stock could have been done with as little as $1,200 for all of you guys that have smaller accounts and are wondering, hey, I don't have enough money to buy 100 shares of a stock to be able to sell covered calls to generate some passive income. How can I do this, right? So that's why with this poor man covered calls is great for smaller accounts because you don't need to buy 100 shares to be able to get the benefit of being able to sell a covered call. So make sure you watch this video till the end, take some notes. And if you have any questions, just of course, drop them in the comments. I love replying to you guys. This is great. So let's get into this. Let's start with the basics. So a covered call is basically where you own 100 shares of any company that you have and you want to sell calls against it to generate some income because you're holding this stock anyway. Might as well have it generate some income for you. So say you bought some stock at $50 a share, right? You bought 100 shares and you're like, okay, I don't mind holding this, but I want to generate some income. So you sell a call at the $60 strike price and they pay you a premium for making that promise that, hey, if the stock that I own at $50, if it goes to 60 or above, I'm willing to sell it. If it doesn't get there, you get to keep the stock, you get to keep the premium, all good. If it goes above $60, it's still all good because you get to sell the stock at $60. You bought it at 50, so there's $10 a share profit right there, and you still get to keep the premium that you had collected. Now, not a lot of people have enough money to buy 100 shares of a stock. This is where the poor man covered call comes in, because this allows you to buy a deep in the money call option way out in the future, over a year to expiration, so you have time. And that acts like your 100 shares because each options contract controls 100 shares. So this way, if you own a deep in the money call option, that is your synthetic way of owning 100 shares. And now you're able to sell calls on a weekly or a monthly basis to generate income off of that. So this way you get the benefits of being able to sell call options without having to own 100 shares and having that capital. So that's what I'm about to show you guys today. So that's basically the gist of the concept. None of this stuff is financial advice. This is all for educational and informational purposes. So now let me flip the camera around and show you guys exactly my thought process behind this. So this particular trade that I'm showing you guys, I did this on July 25th and I did this on CVS. I post all my trades in my Patreon account live when I do this. So this was on July 25th. And here's my reasoning for getting into this trade. When I look at the chart, I was looking at the daily chart of CVS right here, CVS daily chart. And I use the Lux Algo indicators. They're great, just gives me a ton of information. If you guys want to check them out, I've got a link to them in the bio if you guys want to try them out risk-free. So CVS had been going down quite a bit. There's a reversal signal right here, and it was bouncing off of the reversal zone. Not just that, it was very, very oversold right here. So I'm like, you know what? CVS at that time was trading at $60.58 on July 25th. So I'm like, you know what? It's super oversold, great value. Then I did a little bit more research, looked at the fundamentals for it for the fair value compared to market price. So the CVS stock, the implied value over a 3-year period is about $81, and it was currently trading at a 25% discount, which was $60.67. So that made it feel like even a better deal. So if I was to buy 100 shares of CVS at $60.58, it would have cost me $6,000. Okay, $6,000 for 100 shares. But what I did instead, and here I am in my Schwab account so you guys can see, on July 25th, instead of buying 100 shares at the $60 price, which would have cost me $6,000, I bought call options for the $55 strike price that expire all the way in January of 2027. Okay, a year and a half from now, right? July 25th, 2025, January 15th, 2027. And instead of $6,000, it cost me $12.35 a share. So each contract cost me $1,235. Okay, this is what I'll say. This is a lot more affordable for people with smaller accounts. I did 10 contracts instead of one contract. So that cost me $12,351. If I did this with 1,000 shares, because 10 contracts times 100 shares, that's 1,000 shares. If I did that with 1,000 shares, that would have cost me $60,000. So instead of $60,000, this cost me $12,351. And then against those shares on the same date, at the same time, I sold the 66 call option that were expiring in just a few weeks, right? From July 25th to August 15th at the $66 price. Because I'm like, you know what? If it hits $66, I'm perfectly fine selling both of these because this will go up, this will go down. Overall, I'll make a profit. Okay. Just like if I had owned the stock at $60, if it went up to 66, I would have pocketed that difference. Get it? And for that, immediately I got paid 90 cents a share. So each contract, 100 shares. So that's $90 a contract. I did 10 contracts. So after the fees, I collected almost $900 instantly. So if CVS had stayed below $66 by August 15th, I would have gotten to keep my calls that I was going to do, and I could repeat selling calls, and I would have gotten $900 in premium, just passive income, just sitting right there, just owning those calls, just like I would if I had 1,000 shares, but I don't have 1,000 shares, right? I have the synthetic ways of doing this by buying the calls. Now, when I look at after I got into that trade, CVS went up because I was expecting it that, hey, it was super oversold when I got into it, bouncing off of that, right? So it went up. And then here on this date, 6 days later, it hit $66. Okay. And I didn't want to get a sign on this. I didn't want these to get called away because, hey, I don't actually own the shares. This is just a call. So then what happened was 6 days later, July 31st, I closed out this call, the 10 contracts of the deep in the money calls, and I collected $15,773.36 after all the fees. And then I closed out the covered call that I had sold, and I took a loss on that because I collected $900 and I paid $1,700 to buy it back. But the profit from this way made up for more than that. And overall, in 6 days, I ended up making $2,548. This is the power of the covered call. And this isn't like a one-off. These can be done with accounts of any size. If you have a bigger account, this can be done on bigger stocks too. Like I'll show you real quick. I did this on Costco just last week, and it made me a decent amount of money. Yeah, so check this out. Costco, last 14 days. Okay. So I did this trade on Costco starting July 31st, and I got out of this August 7th, right? Just in like 8 days. If I bought 100 shares of Costco at that price, that would have cost me $92,000. $92,000. But because I bought the deep in the money calls, I paid $22,000 for those, right? I did one contract, $22,000. And then I sold covered calls against it and collected $500 in premium. Costco shot up as was expected. I closed out both of those trades 8 days later, right? Sold the call, bought the other call back, and that trade ended up making me $1,800 again in about a week. If you guys like me making these kind of videos, please do leave that in the comment or just follow me. And if you have any questions about any of these trading strategies, just hit me up, just drop a comment. I love responding. And then if you guys want to check out the trades that I'm making in real time, of course, check out the link in the bio and join my Patreon.